Welcome to this explainer. Okay, today we're ditching the retail crowd and diving straight into a systematic, institutional approach to trading. If you want to finally stop guessing and start tracking the massive algorithmic footprints left by institutions, you are in exactly the right place. We're going to look closely at why certain setups fail, and more importantly, how to use those exact failures to your advantage by understanding the mechanics of market delivery.
Here's our roadmap for today. We're going to cover the fair value gap trap, defining the standard FVG, revealing the inversion FVG, walking through your step-by-step playbook, and finally, trading with smart money. Let's get right into it.
Section 1. The fair value gap trap. Because sometimes, perfect setups just fail.
Have you ever felt like the market is just completely playing games with you? You know the feeling. You do your multi-time frame analysis, you spot that perfect fair value gap, and you patiently wait for the tap, you set your orders, maybe even brag to your trading buddies a little bit, and then, bam, price just slices right through your zone like it wasn't even there. You're stopped out instantly. It literally feels like the market is hunting your stop loss, doesn't it? It's super common, and it's exactly what leads to revenge trading, blown accounts, and that gut-wrenching feeling that the whole system is rigged against us retail traders.
Usually, most traders take that loss, get super frustrated, and just storm away from the charts for the day. But wait, stop right there. We are going to totally flip your perspective on what actually makes a losing setup, because a failed gap, it's actually a hidden gold mine. The institutional algorithms are literally handing you highly actionable intel right at that exact moment of failure, if you know how to read the footprint. An invalidated setup doesn't mean your analysis was trash, it just means the market is operating on a slightly different, way more aggressive agenda.
Moving on to Section 2, defining the standard FVG. This is the absolute foundation of our strategy.
So, just to make sure we're all on the same page, here's the baseline. A standard fair value gap, or FVG, is a very specific three-candle pattern. The dead giveaway, the wicks of the first and third candles do not overlap at all. What this leaves behind is a literal inefficiency on the chart, a gap where only buyers or only sellers were aggressively in control. Think of it like a giant vacuum. Nature hates a vacuum, and trust me, so does the market. When price moves that fast in one direction without any pushback, it leaves a pocket of poorly delivered volume. Our usual expectation is that the market will eventually circle back to fill this empty pocket, balance the books, offer fair trade, and then blast off again in the direction of the original trend.
But here's where expectation meets reality. In textbook theory, we expect that gap to act like a giant trampoline, perfectly catching the price and bouncing it right back into profit. We wait for that delicate little tap, but the real market? Yeah, it's not always that accommodating. Oftentimes, a falling knife just slices right through that inefficiency like hot butter. The trampoline is completely broken. When price disrespects the zone like that with heavy volume, it leaves a lot of traders scratching their heads, thinking the strategy is a bust. But what's actually happening is a massive, rapid shift in market structure.
Which brings us to Section 3, the inversion FVG revealed. It's time to flip the script.
Enter the inversion fair value gap. This happens when that original gap you were eyeballing is just completely disrespected by the market. Instead of bouncing, price blasts right through it with serious force. But here is the absolute key detail you cannot miss. A candle body must close beyond that zone. When that happens, the gap completely flips its role. Kind of like how old support becomes new resistance, this failed gap becomes a brand new, highly accurate point of interest for a trade going the exact opposite direction. Why? Well, it's all about order flow and human psychology. All those traders who bought at the original gap, they're now trapped underwater. So when price returns to that level, they are desperately selling just to get out at break even. That massive wave of panic selling fuels a high-speed reversal. The gap didn't break, it just changed teams. So, how on earth do we know if a gap is actually going to invert before it's too late? Well, we use the 50% mark of the fair value gap, a little something we call the consequent encroachment. This midline is literally your secret sauce. If price hits this 50% mark and respects it, the original gap is probably going to hold up and act as a springboard. But if the market violates that midline and the candle body actually closes on the other side, boom, that's your definitive early warning signal that a major change in market delivery is happening. Momentum has officially shifted, the old narrative is totally dead, and the inversion play is fully active.
Okay, Section 4, your step-by-step playbook. Let's look at the mechanical execution rules.
Imagine we're in a super clear, higher time frame downtrend. Price makes a quick move up, leaving a bullish fair value gap that looks incredibly tempting to buy. Step 1, instead of trying to catch a falling knife and buying, you wait patiently. Wait for a strong bearish candle to slam through and close firmly below that bullish gap.
It's now a bearish inversion FVG. Step 2, whatever you do, don't chase the price. Set a sell limit order right at the midpoint, that consequent encroachment level we just talked about of the newly inverted zone. Step 3, tuck a tight, safe stop loss just above the most recent swing high or the top of the inverted zone. And finally, step 4, target the nearest pool of external liquidity. Think of external liquidity like a giant magnet, usually a major swing low where hundreds of retail traders have their stop losses clustered. The market naturally hunts those pools to grab liquidity. Follow these objective steps and you stop chasing the market while locking in a mathematically superior risk-to-reward ratio.
And finally, Section 5, trading with smart money. This is about finding those absolute A-plus setups.
Listen, your probability of success absolutely skyrockets when the inversion fair value gap aligns with higher time frame context clues. We want to see this inversion happen right after the price sweeps a major session high, meaning it takes out the peak of, say, the Asian or London session just to trap breakout traders. Or, even better, we want it to tap into a massive daily supply zone where huge institutional sell orders are just sitting and waiting. When you see this specific combo, it tells a crystal clear story. It screams that the smart money manipulation phase is officially over. Early buyers are completely trapped at the highs, and the true aggressive distribution phase is ready to rip. That, my friends, is when the biggest moves happen.
There is a massive, fundamental difference between taking just an average trade and trading alongside serious institutional money. An isolated inversion pattern that you randomly find on a 1-minute chart with zero broader context, that's an average setup at best. Honestly, it's a coin toss, but an inversion FVG that forms right after tapping a higher time frame daily supply zone and sweeping previous session highs, now that is an absolute A-plus setup. You're effectively taking a highly precise, low-risk, lower time frame entry pattern and perfectly aligning it with a massive higher time frame narrative. You're riding the coattails of the market makers instead of getting run over by them.
Ultimately, everything we've broken down today comes down to this one core philosophy. You do not need to be right 100% of the time to be a highly successful, profitable trader. What you actually need is a mechanical system that you trust completely. Trading is all about having a strict, rules-based approach that strips away the raw emotion, kills the FOMO, and most importantly, totally removes the gambling from your process. The inversion strategy gives you exactly that. It takes a moment of pure failure and confusion and transforms it into a moment of absolute objective clarity.
As we wrap up this explainer, I want to leave you with one final, provocative thought for your next charting session. When you sit down at your desk tomorrow to trade, ask yourself this: are you the liquidity being hunted, or are you trading alongside the institutions sweeping it? Master the inversion fair value gap, stop getting trapped by failed zones, and start riding the true market momentum. Thanks for hanging out with me for this explainer. Keep studying and trade smart.